beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwanese index is trading lower by 1%, and that is after a 20% tariff was imposed on Taiwan.
200 countries around the world have reached out to the trade and tariff team.
Certain critical minerals, energy products, those will continue to be exempted from reciprocal tariffs.
Way up, resistance is the recent high of 24,956. 24,750 on the Nifty, 55,900 on the Nifty Bank.
With the Trump administration, everything is work in progress. Everything can change.
Nothing from the promoter side, nothing from any other shareholder side. In fact, he has some family commitments at Bangalore.
For now, Nifty flat with some negative bias, and it has continued to be quite volatile since morning as well.
And there is a further development. We will be in a position to assess it for our specialty portfolio.
Effective tax rate will normalize to 25% from 16% earlier.
What markets are attempting to do is to manage or attempt a very slight recovery.
$146 points lower. That is the latest. You saw, of course, the run-through, the read-through in terms of what has happened through the course of the day. It's been sideways to lower. The big story, of course, is pharmaceuticals. The Nifty Pharma index started about 1.5 lower, was down 2. Now, it's a 3.5% cut on the Nifty pharmaceutical space. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surabhi and Reema with me. Guys, afternoon.
Hi, good afternoon. And folks, I don't know if it's any comfort. We're not alone in this today. We can just say that. Look at how a lot of Asian markets have closed up, including markets like the Hang Seng or even mainland China.
Kospi, that's down nearly 4%,
Kospi, almost
3.9%.
Europe is down almost 2%. So while, of course, we always argue that some of these countries or many of these countries have got a better deal, trade deal than us, I think the overarching sentiment is that tariffs are overall higher. And that means overall, perhaps a pressure on inflation, maybe lesser trade, maybe more confusion. That's showing up in equity prices today.
It's just that the global markets were resilient up until now. Today is the first time you've seen that crack. For our own markets, we've had this slow, painful grind, and this would be the 5th consecutive week of losses. This week, we're down close to about 0.75% on the Nifty, and month to date, the Nifty is down close to about 3.5%. The Midcap index is down closer to 5%, and all the indices are down except in FMCG index. You've got cuts in consumer names. You've got cuts in IT, banks. Pharma, of course, has been weak, especially today. But barring FMCG, I think there is weakness all over.
Absolutely. I know the comparison with global markets, I think what you guys are saying is misery loves company. Right? So I think,
no, also the fact that it's a final reality check, because yesterday it became a White House document. Yeah. Till then, markets were like, dekhenge, we'll see, maybe there's more negotiation.
It's not, it's 7th.
So actual collection of the money.
No, I think it can change. I wouldn't say, anything is possible. But, you got lots coming up, and Pharma will be top of the pack right here. Ekta will run us through a potential impact in some detail in just a bit from now, right? Because this is the space where there is maximum concerted selling across the board. Look at that. So that's the new bit. PNB Housing, of course, is down 17%. Sharp cut after Girish Kousgi resigned as CEO and MD. We will get you, excerpts of our chat with the CEO of PNB on the program. In terms of earnings expectations, ITC is set to report, so we'll get you a preview a little later on the program. So that's what's coming up. So just quickly run through the index, 24,634. So we're down 130 points on the index, but we've still not broken the lows below which I think there'll be confirmation that perhaps there is pressure. And that low is very simple. That low is the low that the market made 2 days back, 29th of July. And the low was 24,598. That level was not broken yesterday, and that level holds even as things stand right now. And I think same is the case for the Nifty bank as well. We've yesterday's low matters. I mean, these are levels we put out in the morning as part of the sort of setup, and that level holds. It's not been violated. So it's lower. I think it's broader markets which I think are a bit more problematic. 2:1 is the decline to advances ratio as things stand right now. So 800, 850 higher, and you've got about 2,000 stocks which are in the red at this point.
So how should you position yourself in the last hour of trade? Mitesh is now joining in with a few closing strategies. Mitesh, afternoon, it's been a tough market the last couple of days. It's just been a grind down. Your thoughts, any trades in the last 1 hour, and how are we positioned for next week?
Good afternoon. So, I've been advocating that we might be range and chop around and not give a direction move. I think that's happening. But what has happened today is that the bank nifty is slightly, turning on the weaker side. And if that kind of movement follows, then you might see that the bank nifty will decline, which in turn, obviously, as we understand, will put pressure on the nifty as well. So the level which I'm watching on the bank nifty very closely is roughly about 55,600 to about 55,550 zones. And we are only about 150, 170 points away from that. In case we start breaking below that, then I think I will look for and prepare for a slightly deeper correction. 55,547 also happens to be the low for this week. So I think that could be an alert. Below that, I think, good chance that we are looking at about 800, 900 points kind of a decline, and we could see the markets turn weak. But as of now, just watching that level. On the stock side, I have Asian Paints. It had a good move in the morning and then slightly tapered off right now. But from the structure-wise, it's a positive structure. So recommend buying here with a stop below levels 2405. And then, I will look at targets of around 2480. And ONGC is something which to me appears slightly weak. It's just trading above its pivot of 236. So sell below 236, 235 zones, then keep a stop at 240 and look for a 225 kind of a target.
Okay. Got that. Mitesh, just stay on. We want to talk to you about a couple of pharma stocks as well. But before that, let's get to ekes. A lot of pharma stocks have seen plenty of profit taking today, and the cuts are ranging between 3% to as much as 5% on big names like Sun Pharma. Obviously, the overarching concern is what happens to Indian pharma exports. Remember, overnight developments, we've seen that 17 pharma companies, these are innovator companies, they have been sent missives by the US administration to make drugs more affordable. What does that mean for Indian companies, including the likes of Sun Pharma? Let's go to ekes to find out. Ekes.
US President Donald Trump has sent letters to 17 major global pharmaceutical companies, including the likes of Eli Lilly, Pfizer, AstraZeneca, Novo Nordisk, strongly urging them to reduce the US branded drug prices and align it with those charged in other regulated markets such as, for example, Europe. While there is no immediate impact on generics, analysts warn that the long-term addressable market for generic drug makers could possibly shrink. This, coupled with already existing issues such as pricing pressure, could pressure the generic drug market in the US and possibly even result in rejigging long-term plans, such as, for example, in licensing deals. For Sun Pharma, besides earnings, which I will just get to, the spotlight is also on its global innovative medicines portfolio, which includes branded drugs such as Ilumya, Sequoia, Lexelvi and Winlevi. This segment, which accounts for nearly 20% of its total revenue and grew nearly 17% year-on-year in the fourth quarter to $311 million, while the company has not heard from the US administration, analysts point out that any move to cut US branded drug prices could possibly result in the company reducing their specialty drug prices as well. And when it comes to earnings, the company has also flagged that its effective tax rate will normalize to 25% from 16% earlier. This has resulted in a few EPS downgrades, with some analysts cutting their FY 26-28 core EPS estimates by anywhere between 8 to even 13%, but most of them have maintained their rating on the stock. Adding to the uncertainty on pharma, while pharma is currently exempt from tariffs, the pharma imports into the US are being reviewed under Section 232, which is a national security provision typically used to evaluate whether certain imports pose a threat to the US interests or not. Analysts believe it is a medium-term overhang, and any adverse finding under Section 232 could have major implications for Indian drug makers. India, remember, exported $11 billion worth of pharmaceuticals to the US in FY25, accounting for 35% of total pharma exports and nearly 47% of all prescriptions filled in the US in 2022.
Thank you very much for that. Siddharth Bhambre from Asit C. Mehta Investment Intermediates is now with us on the show. Siddharth, thank you very much for joining in. First, give an overall broad comment on the markets and where we're headed. We've been in a bit of a consolidation funk, but we've got this negative bias for the last couple of weeks.
Good afternoon, Rima. Thanks for having me on your show. We are not very gung-ho about market from next 1-2 quarters perspective. We know that there's a lot of noise which is emanating from US, and predominantly, I think globally it's now known that US president really want interest rates to go down. So the interest outflow because of humongous outstanding debt reduces, which in turn would probably fuel the reduced interest outflow would fuel its economy. But it's unlikely to happen anytime soon. So he's taking all the measures through which inflation could go down, and that's the reason you guys were discussing about pharma. Earnings, I think again, market is not expecting or was not expecting very big surprises from earnings. Despite that, we have seen that there are hardly any big positive surprises, and there are a few negative surprises at this point of time. So earnings have also, or I would say the depleted expectation of earnings, despite that, it has not, given any solace to market. And we are seeing, selling from FI as though, every one of us is talking about how SIP inflows or domestic institutional money is coming in. But FIs continue to sell this market. So all in all, we are seeing that from a near-term perspective, at least from this quarter and next quarter perspective, the upside in market is capped. And some of the growth sectors where, market look forward to, those sectors are in problem. And that's the reason we are not expecting anything to come in next couple of quarters. So I would suggest participants to play this market defensively. And we are not ruling out some more downside in this market in weeks or months to come.
Okay, that's the call overall on the market. Siddharth, hi, good to have you on. Specifically on pharma stocks, obviously there's a lot of fear around because they've been fairly resilient so far, especially large cap pharma names in an otherwise weak earnings environment. What is your house call? Do you still have some buys, or those who don't have a very long-term horizon, should they be paring their positions?
We don't have active coverage on pharma, but then, Surabhi, it was pretty evident that when Trump is out there to charge higher tariff to different countries, India, maximum thing which goes to US is IT and pharma. So it was expected that something would come on pharma. People are, asking a lot of questions that which sectors would get impacted. But I think it was pretty evident that IT and pharma would bear more brand. Though we don't track this sector very closely, I would suggest if somebody has to take exposure in pharma, and people should, because a lot of mutual fund guys would move into defensive space. Concentrate on companies which have more of domestic market than export market, especially US. Sorry, I won't be able to add much because we don't track closely.
Got it. PNB Housing, I'm not sure if you have a view, because that's the story we want to address. Stock is down about 18% or so. We spoke with the CEO of PNB, Ashok Chandra, about Girish Kousgi's exit from the subsidiary PNB Housing Finance. Listen in.
Nothing from the promoter side, nothing from any other shareholder side. In fact, he has some family commitments at Bangalore, and that is the only reason for which he has put up his paper. Otherwise, nothing to be seen other than this now, in this particular case now. See, as a promoter, I can only tell that we don't see any challenge in this. This is the personal reason he has cited, and he is moving to Bangalore. I think PNB, the HFL, this board also, they are going to have some investor meet today, and they will clarify all those issues. But we don't see any big challenge, anything happening.
Any thoughts on this one? PNB Housing, Siddharth?
Well, broadly, Prashant, we are seeing that credit cycle is slowing down, and a lot of issues first came out from MFI space. Now, MSME is suffering. And, when Bajaj Finance says that there is issue in credit offtake or in MSME space, then smaller players would certainly, would face the heat. So nothing to contribute on stocks, but on this stock. But I believe the pain in MFI is about to get over. But the pain in MSME has, I believe it's in nascent stage of reversing credit cycle. So I would certainly avoid investors, or I would certainly suggest investors to avoid this space as of now and stick to larger names where at least there is some double-digit credit offtake.
Okay, that's PNB Housing. Quite a disappointment today with Mr. Kausgi's exit news coming through. Just looking at some more movers and shakers in the broader market. Obviously, consumer is an area of interest. I mean, it seems to be the only area of, well, quote-unquote, perceived safety. So, Trent, Asian Paints, Nestle, Lever, ITC. On the large cap screen, these are the names that are seeing some buying. I'm just trying to see what else is on the gaining tally beyond FMCG, if there are any clear trends. Well, not really. Some of the renewable energy plays like Suzlon and Wari are having a very good session today, by the way. Suzlon's up 7.5%, Wari is up 4.5%, and Radico, also part of consumer, and of course, decent numbers coming through once again. Radico is up about 3.5%. So let's take the consumption piece first. Now, this is where the market's hopes are resting. Which are the stocks you like here, if any at all? I mean, and it's across the board, right? It could be FMCG, it could be Alcobev, it could be QSR. Any picks?
We are very bullish over here, Surbhi. If you remember last month on your show, we were discussing about HUL when the change of management took place, and we were sounding quite optimistic. The space has, gone through tough times, and we have all seen that. Last few quarters, the growth was around 1%, 2%, both in sales as well as in volume growth. But now, if a company like HUL is giving you 5.1% on the sales growth, 5.4% on the volume growth, yes, I understand that the EBITDA has softened a bit, but that's how it goes. That first your top line numbers start doing well, and eventually it trickles down to margins. So I believe the space has suffered a lot in last 2-3 years because of first rural consumption coming down, then urban consumption going down, and now there are some traces of urban consumption coming back. And in last 2-3 years, valuations have also corrected a lot. And if you look at mutual fund portfolios, everybody today also is underweight. And with IT and Pharma not doing well, and with markets, in these kind of situations, a lot of churning is left where all these fund managers would start increasing exposure in FMCG space. So expect strong upside in names like, HUL. Last time also we spoke some of the names which we like in related spaces, Varun Beverages, though, there is issue of competition and sales bit slowing down, but the exports are growing well. I last time mentioned some of the names like Bikaji, which we are liking. So we are very optimistic over in FMCG space. And we are taking a top-down as well as bottom-up approach over here.
There's one stock, Credo Brands, that's locked in a lower circuit of about 20%. So that stands out in very, very large volumes today. More than 25 lakh shares traded. This is a company which manufactures men's clothing, casual men's clothing under the brand Mufti. And numbers were very weak. Revenues have fallen, profits have declined close to about 36%. And the company is talking about increasing the ad spend. So it's been hit by softness in spending, consumer spending, particularly in tier 2, tier 3. Numbers came out around, after 12, there was this big crash in the stock, 20% gone on that. All right, Siddharth, we'll leave the conversation here for now. The Midcap Index too is accelerating its fall. Now it's down 600 points, 1% gone. And the Nifty and the sensex are down close to about 0.5%. Thanks for joining in. We get into a break, but before that, here's a reminder for all our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access. Our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with the journalists, along with curated studio tours, e-learning sessions, masterclasses, and curated lifestyle benefits.
Half a percent down on the Nifty, and it's not too bad compared to a lot of the other global screens. We keep repeating that. Perhaps the Indian market's been sensing this, drifting lower because of its own reasons. A lot of other global markets are down between 2 to 4%, as much as, for instance, the South Korean Kospi. Now, trade remains the biggest headline out there, with India being slapped with 25% tariffs and still uncertainty continuing on what are the additional penalties, if any, that we will have to face. Parikshit is joining in. He's picking up some source-based latest inputs on this and where these negotiations stand, and if there's any hope at all of any sort of a breakthrough. Parikshit.
Well, government sources telling us that they are going to be watching the situation very patiently. The effort would be to negotiate, manage and resolve the outstanding issues that have been raised by Donald Trump. Yes, there is tension in the relationship, but the effort would be to somehow resolve this, considering the larger long-term strategic implication of the India-US partnership. Government sources also telling us that national interest will be supreme in all trade negotiations, including those with the United States. Under no circumstances can we compromise on agriculture and dairy. These are red lines in negotiations, and we cannot compromise on interests of farmers, which are a large section of the Indian population, especially those farmers which depend on subsistence farming. Also, because bloodstock in the US is fed with a protein supplement called blood meal, therefore, India will also have to keep religious sentiments in mind and also interests of dairy farmers. So these are very politically sensitive issues for the country. There are interests of a large section of the population involved, and we are going to try and convey this to the US. Now, when it comes to the energy partnership, India is saying that we have a strong energy partnership with the United States, and we will continue to buy more oil and gas from the US in the coming years. And this is a relationship that will only grow under the US Compact initiative. But at the same time, we have to take calls on energy imports based on market conditions and geopolitical developments, and we will always have a diversified crude basket.
Parikshit, thank you very much for that. So the government, remaining firm, at least in terms of the red lines, so-called red lines, that it is not willing to cross. And we'll see how this one goes. But important sort of information in terms of the government stand, all source-based information at this point in time. There's this IndusInd news which came through, right? I mean, I think we put it out in flashes. There's also sources to CNBC-TV18. IndusInd Bank apparently under government scanner. Yeah, under government scanner. Ministry of Corporate Affairs conducts suo motu action against IndusInd Bank. The preliminary inquiry against the bank revealed several violations of Corporate Governance and Companies Act. And stocks, I think, taken a bit of a dip. Government considering to refer detailed inquiry against IndusInd to other regulators and agencies as well. I mean, when it rains, it pours in terms of bad news, right? And for the bank, RBI, of course, has been sort of watching things very closely. And now there is MCA, which seems to be involved as well. N. Jaykumar is Group CEO and Managing Director at Prime Securities. Jake, it's great to have you on the program. Thanks very much. You know, this tariff bit, I know you want to spend some time on pharma, and we will come to that in just a bit, right? But broad thoughts. You heard Parikshit. The takeaway in that sense is that don't expect, I mean, I would read that to say that don't expect any big breakthroughs in the next 6-7 days, right? I mean, we are firm from our side, and of course, I mean, that 25% plus whatever that plus is has been announced. What is your sense? How should investors read what happens from here, near to medium term, Jakes?
Well, I think to my mind, the opening salvo has been fired at 25%. The idea is to buy more stuff from the US. I think what's riling them is the fact that we continue to do our own purchases from various parts of the world, as indeed we should if we are required to be energy sufficient and energy independent. Now, from our perspective, buying oil from anywhere can happen, which is what, if you heard Parikshit, the government sources seem to have referred to the fact that they'll be open to buying more oil, and therefore, for whatever this is worth, this obsession with the trade deficit, that can be actually cut down if you buy more oil from the US on oil and oil petroleum products. And my own feeling is that anything that will happen now will be marked with this particular thing, that which will be seen as a big win for the US, that they are able to sell far more petroleum products to us, far more oil to us. And I think that's going to be an important element in bringing down this optical trade deficit. My own assessment is that, or this is my guess, and obviously there's no information, that we'll probably settle at the 18-20% range as far as India is concerned. And some of the specific sectors that are eliminated, like pharma, etc., will continue to enjoy a zero to no tariff kind of thing because of the fact that we are the lowest cost suppliers of products into the US. This is my broad take, and I do believe that the very fact that overtures are being made about a deal will happen. I think they needed to, in a sense, poke this process forward, and that's why this 25% number was given. Nothing more than that. It's just usual trumpery which is happening, and I don't think we should read much more into this. There's no sanctity about this number.
Fair enough. Now let's come to pharma, where you have some specific thoughts as well. Is the market, first of all, overreacting? The pharma index is down 3.5%. The fear is there is the sectoral tariff, plus there is the indirect impact if these, the innovator companies like Pfizer, Novartis, Eli, etc., are asked to cut prices, and then the fear is they will pressure Indian companies who may be supplying to them. So there is two-way impact in that sense, which is being presumed, I guess. But what's your sense, Jakes?
I think it's complete overreaction. Markets have generally been skittish. Any news on any sector, they tend to react with both their hands and both their feet, as it were. I personally believe it's a huge overreaction. If anything, generics are a boon into the US, a boon for the US. And just to sort of explain this, Trump's issues are with the cost of patented products. His issues are with big pharma. The only big pharma in the Indian context that you can think of, in that sense, having its own, I mean, there are very few companies, but Sun Pharma is the only one that sort of jumps to mind, and that too, a small percentage of their portfolio. Other than that, I'll give you an example of, let's say, a pricing that happens in the pharma space. If the generics equivalent lands on US shores at $1, given the fact that most companies here, and assuming all their margins come from the US, they operate between 20 and 25% EBITDA margins, 30% if you want to be extremely charitable. So technically, the $1 gets marked up to about $1.40 when they distribute, when they sell it to the distributor chain. That's all the markup that the Indian pharma companies enjoy. One going to $1.40, and all of the costs are to their account. From 140, the problem begins actually at that point because three distributors, and these are not names that are known. They are equivalent of the CVS chain, equivalent to the Boots chain in the UK. Three such chains account for 90% of the distribution. This is a point that's been actually on Twitter. There's been an exchange, even as much as Elon Musk talked about it, the Doge talked about it, and I kind of contributed to the discussions to an extent, if you will, that actually the problem child, if you will, is the distributor in the middle. Because the distributor marks up this $1.40 to as much as $4, maybe even $4.50, justifying this on the grounds that the patented equivalent is at $10 or $12. So the markups for somebody who produces a drug is $1 go to $1.40. And for the intermediary, which is the three distributors and then the pharmacies that come into play, and they probably split that difference 80-20 in favor of the distributor, that $1.40 becomes $3.50 to $4.50. And that is where the problem lies. This is a cartel, for want of a better word, because 90% distribution goes through them. And there's enough evidence if you go back in time and do your research on the Doge savings to American consumers is concerned. That particular aspect did have a fair amount of exchange between various people. It's about 6-8 months ago when Elon Musk was still the blue-eyed boy of the administration, if you will. And he talked about how it's important to eliminate the margins here and actually convert this distribution into some kind of a utility, which actually can make way for substantially lower costs. And let me tell you that the lower cost is only happening because generics are coming in at that price. So you can't go after generics and tell them to hike up prices through tariffs, when actually you should, at one level, be eliminating the distributor margins. As far as the big pharma is concerned, some may have a target that they must recover their investment in R&D in 2 years. Somebody may say 3 years. And therefore, the pricing is as egregious as it is. But other than that, there is nothing to say that pharma, especially the generic space, is going to have problems of absorbing a 25% tariff hike. I don't believe that at all. In any case, most other suppliers in the world, Chinese being our biggest, are at a higher level of tariffs. So at best, you can look at the differential. And I don't believe that pharma is going to be put in the same basket in any case.
That's very well explained, Jakes. The only thing is that obviously the US government has said everybody know. So your point is, even if tariffs were to go up, it won't make that much of a difference. We'll be able to, the companies will be able to absorb it. And if they go up, it'll be wrongly so. But given that all this, they also know all this information, right? The people who will decide, hopefully, who knows. But as I think I remember speaking with the Lupin's management, and they said that the cost of making in the US is about 8 times the cost of making in India.
That's a separate issue, by the way, which is why I believe manufacturing going to the US...
That's not going to happen. That's not going to happen at scale in any case.
Will not happen.
But what you are saying is that even at that one becoming $1.30, $1.30 or $1.40, that is, they could be, that margin can compress, or you're saying it won't happen?
I don't think there's any reason to. If that $1.40 became $1.60, all that the distributor is doing is earning not $2 for this, but maybe $1.80. I'm saying there may be some degree of this thing there, but most of the margin will get passed on. There's no question about that. Because the problem child in this is not, I repeat, not the generics guys. They are the folks who, in fact, who haven't as yet gone ahead and, drastically raised prices in order to make up the difference between the patented and the generic. That's not happening in any case. And usually the rule of thumb is if it lands at $1, the generics price, the patented equivalent is usually, 7 to 8 times that. So at 140 into 7 times, about $10. The problem is that the margins of intermediaries are just too high in the US. Now, they may justify it on various counts and, in terms of, the cartelization that happens, but that's the reality.
Yeah. So what should investors do? You said it's a huge overreaction. Buy some of these names?
I think so.
Which ones, Jakes, in particular, you think
I don't want to get to the name, but generics heavy. And to the extent that one or two of these names have some facilities in the US, the US facilities may get from a finishing part of it, may get additional business now. And you may have a higher utilization of the US facilities as a result of this. But other than that, I think there's marginal tinkering at best. Ultimately, I do not believe either tariffs to the pharma sector. In any case, they've indicated that even if they were to come through, would be 12 to 18 months down the line, which is what he himself has said. Of course, there's no sanctity for the fact that he said something and he can't go back on that. But more importantly, the fact that he has only written to the patented folks to bring down their prices because those are extremely high in the context of an individual's wallet, or even if a portion of that was to come through insurance. But I repeat, none of this conversation so far has meant anything to do with generics. So the reaction from that perspective, based on what has been spoken about, I think it's a huge overreaction.
Okay. All right. Take that point on board. Thank you for joining in, Jakes. Good conversation. Good listening into you today. Thanks for being with us. Have a good weekend. Before we move on to all the buzzers that Hormaz has pointed out for us, just take a look at US futures as well. You just saw that flash there. US futures right now are down between 1% to as much as 1.5%. European markets anyway are down between 1.5% to 2%. And this is the real point, that now these tariffs are a reality. So all this while, was the market simply ignoring it and moving on? Will there be a market reality being priced in now onwards? Let's see. You heard Jahangir Aziz in the morning say that inflation in the US is expected to cross 6% in the second half, somewhere around September, October. So will markets start looking at it with a little more clarity? We'll have to wait and watch.
And also Amazon in pre-market is down nearly 8%. So the street was a little disappointed with the guidance. So Apple is holding up okay in pre-market, but Amazon 7.8% lower now. But let's, as promised, get to the buzzers then. Hormuz is now joining in, putting the spotlight on the top movers.
There are some interesting names and some obvious ones as well for today, but we start off with Credo Brands. It's a recent listing, and after this 20% fall that we have seen in today's session, the stock has more than halved from its IPO price, which was 280 rupees. Now, this lower circuit comes on the back of 27 lakh shares that have already been traded compared to a 20-day average of just 1 lakh shares. Now, PNB Housing is the big casualty of the day, one among the many casualties of the day today. 18% lower now after the MD and CEO's resignation, the biggest single day fall since the stock has seen since March of 2021. Almost 3 crore shares traded today compared to a 20-day average of 8 lakh shares. So another big volume mover on the downside. Another stock that has snapped a 5-day gaining streak today is Dhanuka Agritech, and that is also on the back of its results. This fall is the biggest single day drop it has seen since March of 2020, and it has already seen 5 lakh shares traded in this 12% drop compared to a 20-day average of just 80,000 shares. So it's a very big volume mover on the downside. We spoke about Nelcast a couple of days ago. It features among the list today as well, slightly off the highs of the day, but among the top gainers was among the few that are bucking the trend on the small cap index, and has already seen almost 1 crore shares traded compared to a 20-day average of just 2.5 lakh. And it's been a good mover as well. The last 5 of the last 6 years, the stock has delivered positive annual returns. And the last one on the list, which has also snapped a 5-day gaining streak, is Ramratna Wires. And take a look at the volumes here. 3.5 lakh shares traded, 20-day average of just 50,000. And from 2020 onwards, the stock from just around about 35 rupees has gone up to as much as 700 rupees before today's fall. So more on the downside today, multiple casualties, but there are some that are bucking the trend as well.
Okay, all right, got it. Thanks very much for that, Hormaz. By the way, the market is testing recent lows. It's testing lows that we've seen earlier this week, lows which are just below the 24,600 level. In fact, we're right there. On Tuesday, the lowest level that we hit was 24,598, just a shade below that mark. Now, 580. And there's some other updates coming in on tariffs. It seems that because of the exemptions that at least continue till now, 50% of the goods that we're exporting to the US will not be impacted by these tariffs. So let's see. More on this in just a bit. But Manglam's here. Manglam, markets testing the lows of the week. What are you picking up from the FNO screen?
Markets are indeed testing the lows of the week. In fact, there is some feeling of weakness that we're seeing for most part of the day. It was okay. It was understandable. Start of a new series, etc. But now today's low will be extremely crucial to track. Why do I say that? Because, on the one hand, you have the Nifty, the Midcap index, as well as the Nifty bank not doing too well. Broader markets would tell you that portfolios are feeling not very good on August 1st. But the domestic focus has been a lot more than the international uncertainty. So if you look at, the top sectoral movers, you have the FMCG index, which is gaining, and that's on account of the outlook becoming a lot more, better in the domestic sector, whereas there is increased uncertainty around the global facing sector. So you have the IT index lower by almost 2%, you have the pharmaceutical index lower by 3%, and the fact that FMCG has been such an underperformer is what the street is now shifting its focus towards. The Nifty days low. Remember, today, just before this decline happened, the low was 24,611. It was holding on to the lows that we've seen all of this week. So those levels come up for you. But now the Nifty is broken below that. So 24,550 is something that the street is eyeing as the next leg of support. But on the way up, there is a fair amount of congestion. That's what call writers are hoping for as well. Because if you look at the 24,700 call and the 24,800 call, both of them on day one of the series have added a huge amount of open interest. When we started the series, the put call ratio was 1.01, and on day one itself, it's come down to 0.85, telling you that there is a lot of call writing which is taking place right now. So 24,700 and 24,800 calls tell you that between 24,800 and 24,850, there could be a fair amount of supply. So the ceiling's coming lower. And at the same time, if you look at the 24,700 put, those put writers are fairly active. The premium is closer to 170, 200 rupees. And that's telling you that maybe 24,500 to 24,550 is a level that the street is looking at as the next leg of support. But amidst all of this, there are a couple of stocks which are fairly well bid in today's trading session as well. So Keynes Tech, for instance, has some long positions being added. It's outperforming an otherwise wobbly market. And PNB Housing, that's the biggest casualty of today. There's been a near 90% surge in open interest on day one of the series itself. And the total open interest as compared to the market-wide position limits is now over 105%, telling you that the stock definitely is going into FNO ban on day one of the series.
Yeah, absolutely. So some sharp movers there, and the market itself is making a sharp move right now. The week's low has been broken. 24,560 thereabouts is where we're trying to take some support. Let's take a break on that note. Come back on the other side. More buzz from the dealing rooms. Nimesh will join in, and some final technical trading advice as well. Okay, welcome back. Let's straight away get to Nimesh because the real reaction in the market is playing out today. Nimesh, remember we were discussing this in editor's playbook as well. The market was fairly even Steven yesterday, but I think today it's double whammy. A, the expiry effect is over, and global markets are now beginning to price in the reality of tariffs. What are you picking up? What thoughts?
Well, Surabhi, today is clearly a reality check for the markets, right? I mean, yesterday the pullback was more of technical in nature because of the expiry, because of long chart ratios and everything. Even in this series, we are starting the series on an extremely short position from the FI. So somewhere down the line, you will see a bit of short covering as well. But today is a bit of a reality check across all markets and for India as well. But from a flow perspective, it's not like there is very large selling. We need to see what the institutional data throws up. But it's 1:2 on the sell side. But the flows are quite muted, is what I understand from larger institutions today. The broader market is where the bigger pain seems to be in today's market. So they've largely underperformed. And a lot of smaller and mid-cap names are reacting very sharply in today's market on the downside. So that's something to track in the days to come. Technically, 24,500 is a level to watch on the downside. That's a very, very strong, crucial support for the Nifty. If that gets taken out, you will probably see further sell-off in the market. So that's a level. But today's fall seems to be more of the reality check. But again, flows are not very large, is what I understand from larger FIs.
Okay, so we'll wait by because at least in the cash market, there have been big selling and then big buying on the DIF side. We will see what today's numbers throw up. What about individual stocks, Nimesh? What's the buzz?
So the first on my list is Aurobindo Pharma. The entire pharma pack is under pressure. The pharma index is down more than 2%, and so is Aurobindo Pharma as well. But interestingly, for the last couple of days, the delivery marking is on the higher side, and I understand one large domestic mutual fund has been a buyer at lower levels in Aurobindo Pharma. In fact, the company announced an acquisition as well. So maybe a bit of interest there from larger institutions, and especially one particular mutual fund is an active buyer there. Couple of stocks on the PSU side which is seeing selling pressure today. ONGC and Union Bank both stands out in terms of aggressive selling. Remember, Union Bank was part of my list yesterday as well, and there was delivery-based selling. So there is a continuation of selling in Union Bank, but even ONGC stands out on the sell side. And the last couple of stocks, while the broader markets are down, two stocks stands out for me, Timken as well as TTK Prestige. Both are seeing some small buy flows from larger FIs today. So there is some bit of delivery-based buying and interest as well from larger institutions in Timken as well as in TTK Prestige.
Okay. All right, Nimesh, thanks very much for that. Mitesh is with us with what to do today for a reverse trade on Monday. Mitesh, what do you have?
So, Prashant, actually, in this week market as well, I have one BTST and one STBT. On the BTST is JSL, which I would recommend buying with a stop below 700 for a target of 715, 718. And on the STBT side is Infi, closing near the day's low. That's STBT with a stop at 1477 for 1450 odd kind of a target.
Got that. Thank you very much for that. At the day's low now, nearly 230 points lower on the Nifty. But let's talk about the India's macros and the expectations. Remember, the RBI policy is also next week. The question is, have economists started marking down their forecast for India's GDP growth? Well, the CNBC-TV18 poll finds out that not yet. But most of them are on the verge of downgrading if the tariffs stay. There is also a big fall in the inflation forecast for the current year due to food prices and emerging global slowdown. Lata joins in with more.
Okay, well, actually, after the tariffs were announced, the logical thing was what will be the impact on GDP, and that's why I asked about 15 economists. What would it be? Actually, no one's lowered their GDP forecast. Maybe one, but hardly. In all cases, they are standing at 6.3%. That's the average I got versus the Reserve Bank's 6.5%. But all of them are prepared for about a 20 basis point fall if the tariffs stay. So the widespread expectation is that in these 7 days itself, India may be able to negotiate something. And therefore, it may not be 25. The other reason why people are not giving a new number is, what if the penalties are very, very big? So for both reasons, people are standing pat, but everyone has a downward bias to that 6.3. The expectation is if it stands at 25% tariffs, then everybody will lower it closer to 6% from the current 6.3, between 6 and 6.1%. That's the word from the economists on growth. But the surprise find was that all of them have radically cut their inflation forecast. This was coming anyway because the June inflation came in way below expectation. Now, for the full year, the average is expected to be a ridiculous 2.9%. You know, before a month ago, when I asked them after the inflation number, they were all talking about 3.4. The Reserve Bank is standing at 3.7. So look how much the Reserve Bank has to come down if it wants to come to the street level, almost 80 basis points lower. But the reason is that as it is, food prices have been low in the month of July. The bigger point is that the disinflation that will be caused if goods can't be sold to the United States, the expectation is that there will be, we saw the copper price fall. Likewise, the expectation is that there could be a general disinflation even in non-food items in Asia. So all that, of course, is leading up to more expectations of one more cut.
Okay, all right, Lata, thanks very much. So in terms of forecasts, just sort of standing pat at this point in time, waiting and watching over the next couple of days, quite literally, right? Because you don't know what's going to happen, both on the rate and, of course, on the penalty, as Lata pointed out as well. Let's talk about another name which is actually selling off, Niva Bupa. We spoke with the management early on, but let's just get a wrap out of the numbers themselves. Why is the stock down 6%? Yash, take it away.
Well, Prashant, the story lies in the numbers itself. The first quarter results pretty weak from the top to the bottom. To speak about the premium growth itself, the growth here has been tapering. The company's managed to grow its net earned premium at about 20% in the first quarter, but the story gets worse as you move down the order towards the operational performance. Underwriting loss, that has increased almost 100%. The underwriting loss has doubled to about 234 crore rupees. The operating performance, there has been an operating loss. There has been an operating loss, that's correct, of about 145 crore versus an operating profit of 23 crore. The combined ratio as a result of which has spiked all the way to about 116.97 as compared to 106.09. The PAT is down about 91%, is down to about loss of 90 crore as a result of all these things. And all those factors from the top to the bottom in terms of operational performance and the growth itself weighing down on the stock today.
Thank you very much for that. Another one which is under severe pressure is Graphite India. Came out with numbers about an hour back, and disappointing set of numbers. Revenues are down nearly 9%, EBITDA down 60%, profits have fallen 45%. The stock has taken a knock, and along with that, HEG, which did well, post its numbers earlier this week, that's also seen a sharp correction. But all eyes will be on ITC. Awaiting numbers here, Mangalam joins in with the expectations.
Well, FMCG stocks are generally doing well, but ITC has been a bit of an underperformer here. It's closer to its 52-week low than its high. And, valuations-wise, it's always traded between 22, 23 times, at sometimes 24, 25. But this time around, unlike all the other FMCG companies, ITC may see a bigger impact on their performance, not because the consumption space is not doing well, but because leaf tobacco inflation may impact their core business, which is that of cigarettes. So, if you look at the standalone numbers, excise, you will see the revenues at 17,637 crores. And it is this absolute number which is more important than the comparable, because this is also the second quarter where the company is reporting numbers X of its hotel business. So not look at percentage change, but the absolute 17,637 crore on the top line, 6,300 crores on the EBITDA, which implies a margin of closer to 36%, and a net profit of 5,005 crores is what the street is working with. Once again, year on year, not comparable because it is, X of the hotel business demerger. What are we expecting? 3 to 4% cigarette volume growth, led by 5 to 6% revenue growth. So the cigarette EBIT will actually grow a step shorter than the cigarette volume. So we'll watch out for that. And we have 5 to 6% growth in FMCG revenue. However, there could be contraction in FMCG margins, which we've seen because of the inflation in palm oil and other raw materials as well. 20 to 25% growth in agri revenues because leaf tobacco prices have increased, and at the same time, the government laws around exports of agris have also loosened up. So this would be a sector that benefits from that. But subdued conditions would mean the paper business grows just around 4 to 6%. So all in all, a not so very good set of numbers expected for ITC. But then again, the stock is reflecting that.
Thank you very much for that. Get into a break, counting down to the close today. Remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, leaders, economists shaping both the world and India's future. CNBC TV18 decodes global shifts, their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. It's turned out to be a weak afternoon of trade. There's no other way of looking at it. And almost all sectors, actually not just a weak afternoon, the week also, barring the FMCG index, which has managed a 3% climb, all other sectoral indices are negative, and today's tally is on your screens. Mayuresh Joshi is with us, Market Smith India. Mayuresh, so tell us, I mean, it's tough and there seems to be no immediate clarity. But on pharma specifically, I mean, people would be really worried. What is the call you're taking on stocks like Sun Pharma? I mean, what was your rating? Would you be changing that rating if tariffs become a reality on pharma?
Absolutely. I think the rating was always neutral. And I think with the impositions that are now expected to come through and the kind of numbers that have also come in, I think the OTR guidance that they've probably given of 25%, obviously a lot more is expected in terms of the aligned benefits that it gets from the Ranbaxy element. And therefore, I think within pharma, I think we've been very, very selective. I think hospitals as a space is something that we continue liking within healthcare as a domain. And therefore, our own sense is that hospital stocks which are probably expanding their operations in a very inorganic manner and also in an asset-light manner, along with expectations that all the new hospitals that are coming through will probably lead to better operational matrices and dynamics. Tend us to believe that within healthcare as a space, hospitals might relatively do better. So I think hospitals like Fortis, KIMS is something that we continue holding in our.
Any thoughts on IIFL Finance? Mayuresh, today, this whole rise in credit costs that they're talking about, clearly the market is in no mood to digest any of such commentary. Stocks down 10%.
Absolutely. I think in a weak market, if you're giving such a commentary, I think that's not going to aid and assist the fortunes for the stock. And that's what the reaction of the street has probably given. Obviously, the rise in credit costs will mean that there will be implications as far as core parameters are concerned. And specifically on an NBFC, I think maintaining those credit costs within a range is extremely critical because you're absolutely dependent in terms of your borrowing mix for sources outside your domain. And therefore, I think the kind of borrowing mix that you've probably got, the operational dynamics that you probably carry through are extremely important. And therefore, I think credit cost, asset quality, the risk-weighted ratio compared to the total assets becomes extremely critical from a performance perspective. And I think with the credit cost increase, I think there might be some element of increased and infinite pressure on earnings.
Negative news pouring from all corners today. Look at UPL's update. Their impairment costs have gone up, and what was supposed to be receivables from client, now it's been turned into an impairment, and that explains the loss that they have been hurting with. Final thoughts then, Mayuresh. Anything positive? I mean, any interesting buy ideas this week? There's plenty of negative news. Leave us with anything positive.
Well, absolutely. So I think out of the results, I think everybody's probably being a little bit sanguine on auto. I think Hyundai India is something that we remain extremely constructive about. I think numbers have been pretty decent. They're expanding their capacity. So I think capacities will go up from 8,24,000 units to 10,74,000 units. The SUV market share is pretty reasonable and very decent for Hyundai. Again, I think the CNG penetration through their models Exter in particular, the expectations in terms of new launches coming through, I think will hold in good stead. Margins are relatively better between 13.5%, 14%. It's a cash-rich balance sheet. And therefore, our own sense is that within autos as a domain, Hyundai is something that we continue liking in markets.
Okay, the bell has gone, Mayuresh. Thank you very much. Let's quickly recap what's been a really tough Friday, ending up what's been a negative week for the market as well. For the week, the Nifty is down 1%, Midcap index down over 2%, and small cap index down over 3%. And today's tally, the Nifty has broken the earlier lows of the week, 24,570, a 1.5-month low for the index. The weakness was pretty much everywhere, but Pharma takes the cake. Sun Pharma down 5.5%. Dr. Reddy's down about 4%. Cipla lower by about 3%. So plenty of fear around what's happening with US policy on pharma imports. We've seen further weakness in IT names like Infosys, down 3% on Infi. Tech Mahindra is down about 2% as well. And beyond all of this, Adani Enterprises 3.5% lower, Tata Steel 3% lower, Tata Motors 2.5% lower. Many of these companies obviously are globally linked and weakness all around. The only place to hide today in the market was really FMCG and consumer. So Trent has managed a gain of about 3%. Asian Paints 1.5% higher. And then you have Nestle, ITC, some of these names also pitching in with small gains. The saving grace for the bulls was that Reliance managed to notch up a 0.25% increase by the time we closed. Otherwise, this cut could have been even deeper. The bigger problem obviously was in the broader market, mid-cap market. The advanced decline ratio is quite negative. Over 2,000 stocks declining today, as you can see on your screens. And if I talk about the weak hands, then, where does one even begin? PNB Housing Finance takes the top honors, 18% lower. But this is not because of earnings. This is because of Mr. Girish Kausgi announcing his exit from the company. IIFL Finance that we were just discussing, credit cost issues showing up there. And even stocks where earnings